Hi everyone and welcome to this week's Capital and Context. As you can see, I'm solo this week, so you're just dealing with me, Sam Hallett, the Chief Investment Officer of Berkshire Asset Management. Mark is rather enjoying himself watching South Africa at the World Cup, where of course we wish the team well, as well as of course England. But in the meantime, let's concentrate on what's been going on in the markets. So of course, important to note once again that this podcast, is meant for educational purposes only, not meant directly as advice. And obviously, past performance that I mentioned, just for reporting purposes, they're not meant as kind of like this is where things are going, etc. Obviously, we're authorized and regulated by the FCA. As part of Ascot Wealth Management. The aim for this is for it to be directed to a professional audience mostly. However, we recognise that retail audiences might also learn some bits along the way and help them on their investment journey. So what's been going on last week? So actually quite a lot. So last Friday, so that being the 5th of June, we had the US non-farm payrolls report, and that was actually quite a big deal. So that came in at 172,000 jobs added rather than 82,000 expected, and this was seen as quite a what's called a hawkish signal, so a reason to increase interest rates, just because it's removed the pressure to worry about, what was called a soft landing. So, trying to bring inflation down by easing interest rates whilst trying not to lose too many jobs. Well, in this case, we've removed the need to worry about jobs. Jobs are really strong. So that was seen as a signal that the Fed isn't going to be cutting as much as expected this year. Then we came to what was yesterday on the day of recording, so Wednesday the 10th of June, and we had the US CPI, so inflation data come through. Came in at 4.2% year on year, which is the highest since April 2023. And that was the market reaction to that, kind of saw it as a negative, well, quite clearly as a negative. But I think the thing to look at was the core PCE data, and that was actually what the Fed primarily look at. And that came in at 2.9%, which was below expectations. So I think that's actually quite an important one to look at. Today, recording this in the morning, so early afternoon, comes out the producers' price index. So that's the cost that basically factories have to pay in and out rather than retailers. And I think that's going to be quite an important one, so we see that. But what has been quite important, that I don't think anyone else is really picking up and talking about, has been about China May PPI print coming in. So that same print with regards to what the factories are charging or what they're being charged to take in. What's coming, that same figure in China, that came in at 3.9% up year on year, which ended a 41-month deflationary streak. So that being inflation being negative for US factories, for Chinese factory, last 41 months, continuous. Now, I think this is really important because of how basically it's made a lot of central banks in developed economies, we say developed economies, let's not forget China is the world's second largest economy, has made their job quite a bit easier with these falling prices coming out from China. That turning around, I think, is going to end up being a complicating matter on what goes on with central banks for the next 12 to 18 months. It's going to be quite interesting indeed. Looking at next week, so Tuesday and Wednesday is the Fed meeting, US Federal Reserve, and this is an important one because it's the new Federal Reserve chairman's Warsh. It's his first chaired meeting, so that's a big deal, and it's also the dot plot meeting, and that's an important one which we'll talk about in a second. Thursday, so next Thursday the 18th, in the morning comes out the UK CPI print, but also the same day is the Bank of England base rate meeting as well. So that's going to be an important one. So just what I was talking about there, the big inflationary anchor of the last 20 years about cheap Chinese export, it's just flipped. So it's going to be quite interesting indeed. I think when we look at those CPI numbers out from the States earlier this week, I think the thing to look at that's really important is it's 4.2% year on year, but we have to look at things that are not surprising. So obviously energy is up 23% year on year, largely due to the Iran conflict. The core measure was expected to be 3.0, and I know we're talking about a 0.1 difference on the year, but that's we were thinking about a 0.2%. Sorry, we were expecting 0.3% month on month, which obviously if you put that out through, it comes out 3.6. This being up 0.2, it's a material 1.2% difference. So that makes quite a big difference, I think, in terms of what the Fed is thinking. So I think, when you look at the core commodities aspect, so this is kind of stripping away that gasoline price, etc. The core commodities came in at minus 0.1% month on month. And I think that's quite interesting. I think that really kind of reduces the critical aspect of the Fed needing to rise. I think we're looking at a case for the year of, say, like a 45% chance of the Fed basically being flat for the year. I think we're looking at, say, about 35% chance of a Fed hike at least once in a year. And still there's the chance of about 25%. So, it's less, but it's not negligible, of a Fed's decreasing rates this year. So that could be interesting indeed. But I think it's really important to take in, as I said, that PPE data that comes out later today. And that will change the picture perhaps going into next week. As I said, with China, this is quite a turnaround in terms of kind of like, as I said, that disinflationary factor with cheap exports, that turning around, that is a big deal and could result in structurally for a very long time higher rates to kind of keep inflation under check. When we're looking at this, hasn't been a one-off with Chinese PPI data being positive. First one happened in March, it then increased in April to 2.8%, and then in May to 3.9%. So it's actually increasing quite quickly. The three drivers is obviously is energy. The Iran shock means higher mining costs. So the mining costs are up 15.8% year on year. So that's quite big, and that goes straight to the factory gate. And then Beijing has also, so I say Beijing, obviously I mean China, has actively stopped price cutting. So, it's not just trying to undercut all the time now on steel, solar, EVs, etc. Don't get me wrong, it's very cheap, but it's not actively trying to undercut. It's trying to actually have a more stabilized economy. And actually, for the first time, inflation is now a policy goal. So that changes things around quite a bit. There's a little bit of kind of like a structural exhaustion with trying to be deflationary. Wages are now up substantially. This has been going on for some time, but China's no longer the low-cost economy of the mid-noughties. A lot of that kind of manufacturing has been moving to other parts in Asia. China is now starting to be a place of increasing financial living standards, and obviously those pressures change across the whole world. We're dealing, of course, with an economy of over 1 billion people, over a sixth of the world's population, so it really matters indeed. China, obviously, just to reiterate, was doing an awful lot of disinflationary lifting and making the last couple of years quite a bit easier for central banks. It's now going to be exporting inflation, so that's going to be quite important. So why are the BOE and Fed stuck? They're stuck for different reasons. When we look at the last meeting, so obviously we ended up with a hold at 3.75%. The last vote was split 8-1, so 8 hold, 1 rate increase. Whereas we look at the Fed, everyone was holding for up to the last meeting. The last meeting vote went 8-4, so 8 to hold and 4 to increase. And I think that's going to be quite interesting with the new Fed chair coming in to see how hard can he keep people in line with what he's thinking. I think they might end up being what's called a reluctant hawk, in the sense of, like, obviously Trump was very pushing on the whole lowering interest rates thing. So that's what Walsh has been nominated upon, etc. But the thing is, though, he's got to navigate this field of doing what the Trump administration wants him to do versus trying to maintain institutional credibility. And that's really important at the moment. There was a period last year where we were quite worried about the institutional credibility of the Fed. And if that were to fall apart, obviously, the dollar would be very negatively hit, as would US Treasury rates. So I think that's very important indeed. I think when we're looking at the data, though, as I said, that jobs blowout last week, and the highest headline figure, though, as I said, the core figure was not bad, terribly. Along with that, China disinflation story disappeared. He's got a bit of a fight going on there, but I think it's quite clear that Walsh won't institutionally within himself be more hawkish than Powell. So I think that explains what's going on there. Whereas the BOE is kind of the opposite. It's what's called a trapped dove. The BOE wants to cut. It's had the biggest downgrade in GDP expectations out of the whole of G20, down to 0.7%. Unemployment is rising. It's just gone over 5%. It's currently at 5.1%, and that trend is continuing. But it can't cut because CPI is going to raise to around about 4% by year end, if not a little bit more. That's the expectation. So, you've got rising inflation in a stalling economy. It's very much a stagflation story. It's very much a negative story from a bond perspective. So what are we doing to counter that? So we're holding shorter dated. We've pivoted more towards shorter dated gilts, UK government debt. But also we've been holding this long short, so it's been able to take positions on both sides rather than just buying instruments. Excuse me. On fixed income. It's a very interesting fund, and actually I think could work quite well in this environment where the negatives are clearly out there as well as positive stories. There are positive stories out there, but I think at the moment it's important to concentrate on what's going on structurally on inflation. Things to look at for this week. So, as I said, next week we've got the Fed meeting. It's not actually the meeting, the outcome itself. The hold, I think, is pretty certain. It's going to be the what's going to go on in terms of a dissent. How many people are going to vote for a rate rise, and that's going to be very interesting, as well as looking at the notes. It's very, as I've said with my conversations with Mark many times, it's not actually the vote that matters terribly. It's a lot of cases that's already priced in. It's more of a case of what goes on in the notes. What's the language used? Have they removed, language talking about this is the environment that we need for rate cuts? If they remove that language, then that's a very clear signal that we need to be thinking more about rate cuts coming in. So I think that's important. The thing that's also going to be quite interesting moving forward is keeping an eye out on private credit. So myself and Mark did have an episode on this lined up for last week. Unfortunately, we had operational matters that we needed to attend to, so this will wait for next week. But there's an environment that we need to be careful of with private credit. So 14% of US private credit currently cannot cover its interest from its own cash flow, which is doubled up from a year ago. If Fed rate rises increase, that's only going to get worse. Every rate rise is going to add between 1.5% to 2% onto that problem. So this is something that you need to keep an area on that space. It's going to be the canary in the coal mine when it comes to US credit problems. As it's not crying yet, so there's not much to worry about too much. However, the thing is, though, is that's where we keep our eye on. Credit is actually very cheap in America at the moment. So that's why we're holding, again, that long short fund. Just gives us a bit of protection if the credit starts to get more expensive, i.e. sells off. So that's quite important there. We got the UK CPI, as I said, mentioned that. To be honest, if it's more than 3%, that's considered quite hot. If it's under 2.8%, it actually gives space for an August rate cut. But I think the thing that you need to really look at is not goods of CPI, it's going to be the services CPI, because that's when it starts to show that it's actually getting more embedded in the economy, and that's what the Bank of England look at very much. We're looking at if we get the dissents moved down to something like 2 from 4, at 7 to 2, that lays the groundwork for those that rate cut. But however, if we end up with two hawkish dissents, that could change the environment, and I think it's going to be quite interesting to look at. As I said, in terms of how we're navigating it, that short-dated UK fixed income, it's quite important. We've been, for quite some time, as you know, been sceptical of rate cut trades. Anything that needs several cuts, it's quite an aggressive story. Talking there about the structural dynamics have changed, with China now starting to export inflation rather than disinflation. It adds a risk not just on rates, but also on equity risk. It feeds the margins take about 4 to 6 month lag. Those staples, discretionary, anything reliant on Chinese inputs, that's going to cut the margins there. So that could be quite an interesting element to keep an eye out on it within, say, like consumer discretionary, those kind of spaces in the US and in Europe. And I think the other thing as well is looking back at we actually have unhedged our US equity. Now we just see this case where the Fed has more room to be more hawkish if there's a structural inflation story. The economy is stronger, the jobs is stronger. The Bank of England doesn't have such a strong case. Don't get me wrong, the Bank of England doesn't have a mandate to look after jobs. It only has a mandate to look after inflation, whereas the US Fed has both mandates. But it creates a situation where you can see sterling to US dollar weakening, and that helps give that decision extra weight. So I think that's quite important. So when we look at the 5 risks moving forward, so of that thesis, if the whole Iran conflict, and obviously the Iran conflict is more of a regional conflict, it's not just Iran in itself, resolves, if we end up in a situation where oil is somewhere about $70, which I think would be over optimistic, but obviously that energy tail risk from inflation's gone, China PPI starts moderating, and you could end up with a situation where the Bank of England and the Fed restart their cutting cycle. So that's something certainly to keep an eye out on. If US labour deteriorates suddenly, I don't see that really in there. There's quite a lot of strength going on there, but one bad non-farms payroll report can really change this situation overnight. If we end up with a situation where the new Fed chairman, if he overcorrects this situation, from, let's not forget, his confirmation hearing was very much split across party lines. He's got quite a lot of credibility pressure going on. He could end up going too hawkish. So at the moment, press conferences, his tone matters more than normal. And, there's a complacency problem here, perhaps, in the sense that we've had 3 years now of false dawn cut narratives. Everyone's getting a little bit fatigued with that. The data's telling you that things have fundamentally changed. He might make a policy mistake there, so that's quite important. So just to recap there, looking at what's happened, we've had a really positive US job support. CPI came in very strong, but the core actually came in slightly under. So mixed bag there. We've got basically the factory inflation data this afternoon, and that's going to be quite interesting because of, as I was saying, about the China PPI change. So the Chinese have started to export inflation. How quickly is that going to feed into other parts of the world? So that anchor there is gone. And then looking next week, you got the US Fed, Bank of England, and you also have US inflation. And those 3 events take place in 30 hours. So myself and Mark are certainly going to have a busy week. I think just to leave you on the thought, which is going to be cheap China is dead. It's now going to start increasing its rates, its costs coming out into the other parts of the world. And that's something that's going to put pressure on the other central banks. So I think that we're going into a more difficult time, I think, for central banks now for the next 5 or so years. We're going to navigate that in the ways that we've spoken earlier, but as is always the case, we stay dynamic and we'll keep an eye out on the portfolios and any data coming up. I don't think everyone's really taken in that Chinese data yet, so that allows us to be ahead of the curve and help us navigate this environment and produce positive outcomes for our clients. So thank you very much for listening. I hope you have a good weekend if we get this out before Saturday, and catch you next week, hopefully with Mark, for another episode of Capital in Context.